life reserve, but that is the cumulative profitability increase. On that you will have to pay tax of 30. So your cash will go down by 30 and your equity will increase by 100 minus 30 or by 70. Right? So this is how asset would be equal to liability plus equity after making the adjustment. The other rule in income statement adjustments. So the key thing to remember is income statement is prepared for a period of time. It's not, the accounts are not cumulative, right? So here all the adjustments in income statement account are with change in life for reserve, not the cumulative life for reserve or ending life for reserve. This is change in life for reserve. That is your ending life for reserve minus beginning life for reserve. That is called change in life for reserve. So here cost of goods sold first in first out is equal to cost of goods sold LIFO minus change in life for reserve. So you see your cost of goods sold LIFO, you are reducing the cost of goods sold by change in life for reserve. So it means your cost of goods sold FIFO will be lesser in based on this formula, unless the change in reserve is negative, and then it would be added. Now, generally speaking, because this is reduction in cost of goods sold, your gross profit and your earning before taxes will be higher. Once again, you will have to pay additional tax on this increased profitability, right? So your taxes FIFO will be equal to what were your taxes based on last in first out into change in life for reserve into tax. That is additional tax on change in life for reserve. So once again, it's an income statement item. That's why the focus is on change in reserve. And net income for the year is net income LIFO plus change in life for reserve net of tax, right? So this is total increase in profitability less tax on profitability, and net of tax profitability is added to net income LIFO to calculate net income FIFO. So most important once again that in income statement adjustment the focus is only on change in reserve. In balance sheet adjustment, all adjustments are with ending life for reserve. So let's move on to our long-lived asset items. In long-lived assets, the most important point where usually we have received most questions is revaluation, right? That how to deal with revaluation. So here you will be given a carrying value of the asset, that might be historical cost of the asset, and you will be given fair value of the asset. Remember, whenever fair value is greater than the carrying value of the asset, the difference, this difference goes into other comprehensive income. You increase the value of the asset to its fair value, which is above its carrying value, and the difference goes into a revaluation surplus account that is part of other comprehensive income in equity. But if you are given a case where fair value at the end of the year is lesser than carrying value, then any value below carrying value, it goes to income statement and recorded as impairment loss. So you reduce the value of the asset in the balance sheet to its new fair value, which happens to be lesser than carrying value, and the difference is recorded in the income statement. So of course that is an oversimplification, but first of all, if the fair value starts going down, first of all you remove the revaluation surplus, and once revaluation surplus is zero, any loss is recorded in income statement as impairment loss. Similarly, if you have recorded loss in income statement and then fair value starts going up, first of all we keep recovering that loss or as an impairment write-up in the income statement. Once it reaches carrying value, original carrying value from where you had started writing it down, any increase above carrying value once again goes to revaluation surplus. So general rule, any increase in value above carrying value will be in revaluation surplus or in OCI. Any value or any reduction in value below carrying value will be in income statement. Then we have to see the impairment checks and amounts, and the US GAAP. The impairment check, impairment is an asset is impaired if its carrying value, the value at which you are reporting it in balance sheet, exceed undiscounted future cash flow of the asset. If this is the case, this asset is impaired. So how much is the impairment loss? That is carrying value minus the fair value of the asset, right? So we reduce the value of the asset to its fair value and we record impairment loss in the income statement. Under IFRS, the check is if your carrying value exceeds the recoverable amount of the asset. Recoverable amount is maximum or higher of two values: fair value of the asset minus any cost to sell, right? You can say net fair value and value in use, which can be present value, future cash flow, whichever is higher, that is the recoverable amount. And if the carrying value is greater than the recoverable amount, the asset is impaired, and the difference of the two, carrying value minus recoverable amount, gives you the impairment loss. In US GAAP, the impairment losses, or once assets are impaired, the loss cannot be recovered going forward, except in few cases. IFRS allows the reversal of impairment losses. Then we move on to the income taxes area. The most important equation or calculation is the income tax expense that is reported in the income statement. We are talking about this tax expense in the income statement is equal to tax payable that tax authorities ask you to pay, or that is tax payable as per the tax return, plus change in deferred tax liability minus change in deferred tax asset. Now, this is a fundamental relationship. So it's possible that your tax payable is lesser and the remaining part is deferred tax liability, or your tax payable is actually higher than tax expense, so we record deferred tax asset. Then very important concept is, if you are recording deferred tax liability, then asset in the balance sheet, and your tax rate changes. If your tax rate increases from previous year, both deferred tax assets and liabilities will increase. If your tax rate reduces, both deferred tax assets and liability balances will have to be reduced. How much will be the change? So change in deferred tax liability or deferred tax asset, this is change in deferred tax liability or asset, is equal to new rate minus old rate over old rate times beginning deferred tax liability or beginning deferred tax asset. So remember, this formula is giving you the change. So the new deferred tax liability will be beginning deferred tax liability plus change in deferred tax liability, and new deferred tax asset will be beginning deferred tax asset plus change in deferred tax asset, right? You can straight away calculate the new deferred tax asset or liability. The formula will be slightly different. That will be new rate over old rate into beginning deferred tax asset or liability. That will straight away give you the new deferred tax asset or liability. Then the generic formula for deferred tax liability, that when a deferred tax liability will be created, whenever your earnings before tax in the income statement, EBT, exceeds the tax payable or taxable income actually in the tax return, deferred tax liability will be created, right? So your expense is more, you are being asked to pay lesser, right? Or your taxable income is lesser, the remaining you will have to pay in future, and that is deferred tax liability. And also from balance sheet point of view, whenever carrying value of asset is greater than their tax base or what is in the tax record, that will create or that will increase or that will lead to creation of deferred tax liability, and vice versa for deferred tax assets. Then in long-lived liabilities, we have received a lot of queries regarding recording of capital lease or finance lease in the books of lessee and lessor and related cash flow impacts. So let's say if an asset is leased and that lease is classified as finance lease by lessee and the lessor, you know the criteria that if as per contract, title will transfer at the end of lease term, or there is option to transfer the title at the end of lease term, or in case of US GAAP, the life of the lease duration is greater than or equal to 75% of useful life of the asset, or present value of lease payment is greater than or equal to 90% of fair value of the asset on the inception of lease. If any one of these conditions are met, it should be recorded as finance lease or capital lease. So how the lessee would record it in its books? So on the balance sheet, the lessee, the tenant of the asset, would record an asset and a liability that is equal to lower of present value of lease payment and fair value. For your exam purposes, you will always take the lower of present value of lease payments. It's usually not a complicated question in exam. And the lessor will remove the asset from the balance sheet and record the present value of lease payment as a lease receivable as another asset. Then in income statement, so the lessee have recorded an asset and a liability. The asset is normally depreciated. So in income statement, the lessee would show depreciation, and also the lessee is paying an installment or lease installment, and this installment would have two components: the interest component, which is recorded as expense, and the capital component would reduce the liability, and with the last installment payment the entire liability will be reduced to zero. Lessor, in its income statement, the interest component of that installment, lessee records it as interest expense, lessor records it as interest income. Then in terms of cash flow, once again, one installment is being paid by lessee and same being received by the lessor. From lessee's point of view, installments have two components, interest and the capital or principal portion. The interest is shown as cash outflow from operations, and the principal element is shown as cash outflow from financing, right? So of course we are talking about US GAAP, and lessor records the interest component or interest receipt as cash flow from operations, and the principal element of the installment as cash inflow from investing activities, right? So this is our treatment of finance lease in the books of lessee and lessor, and it's a quick summary. So that's about it, and these are the quick topics. Of course, the focus is on key tips, tricks, and most frequently examined, what we think are usually most frequently examined areas. And thank you very much. Please keep the questions coming.